Good morning, good evening, good afternoon, students. Whenever you're watching this, this is Mr. McRitchie explaining monetary policy. We are in Unit 4. We have done the banky stuff. Now we get to do the fun stuff. This is the stuff that involves everyone's favorite, not technically part of the government, but sort of kind of part of the government, the Federal Reserve. So, here's the deal. This one's a lot of words, guys. This is a lecture that's just so many words. So, be very careful. You're gonna get bored at a point. I might be incredibly quickly into it because it is just so much words. And the best part is it's words you have never heard of before, which it means it's very easy for you to just fall off the wagon. If you do that, pause, recompose yourself, drink some water, breathe, get back in. There's a bunch of stuff here, and it's all annoyingly really important. You have to get these to be able to do any of the graph stuff in the unit, which is coming in the next string of videos. So this is the last, just sort of, here's the last bit of content before we kick you into the deep end of this unit, which is 3 different graphs. So, if you get stuck, ask questions in the comments, of course. If you're in my class, just ask me in person. If you're a teacher watching these, just email me if you've got my email. If you don't, find me on Facebook. You'll find me. I'm out there. I help. Okay, so monetary policy, Federal Reserve. Let's freaking do this. Here we go, gang. Monetary policy and Federal Reserve. Okay, so monetary policy. This has been touched on before when we covered fiscal policy back in Unit 3. We mentioned, hey, there's fiscal policy, which is stuff done by the government in America, namely Congress. And then you've got monetary policy, which is stuff done by the central bank. Here's what we're talking about. The central bank, which in America is called the Federal Reserve, or the Fed for short. I will call it the Fed a lot. It's a shorter word. To be clear, this is not the Feds. In pop culture, they are referring to federal police officers. When we say the Fed, we mean the Federal Reserve, which is the central bank. In Japan, it's called the Bank of Japan. The Euros one's called the ECB. The Bank of England is the one for the UK. This is when this entity, which is effectively the bank's bank, it is the bank's dad. It is the bank the banks go to so that they can get loans. When I say banks go to, I mean commercial banks, like your Wells Fargo's, your Chase's, your Bank of America's, all of these ones that you might use, including credit unions like Navy Fed. They call up this guy when they need a loan, and they might save their money at this bank, and this is the guy that also regulates the minting process. So the central bank is super important, one of the most important things in our economy. So what they're trying to do, the same stuff that fiscal policy is trying to do: full employment, price stability, long-term growth. That's the big game here. That's what they're trying to do. They're trying to maintain full employment, maintain price stability, encourage long-run growth. That's the same stuff fiscal policy is trying to do, right? It's trying to put our economy in a good situation, okay? How do they do this, though? Because fiscal policy was kind of straightforward, McRitchie. It was government spending and taxes, and I kind of knew that already. Great question, me. So what they're truly controlling is the money supply, that M1 measure of the money supply. And by association, they're going to be controlling interest rates, like how expensive it is for me to get a loan or how beneficial savings accounts are for me. So while they aren't directly dictating to banks saying, hey, charge more for loans or put more for people's savings, what they're going to do is sort of skew things, incentivize things a particular way that allows for banks to choose to make loans more affordable and choose to offer you more in savings. So they're kind of pressuring in a positive way, kind of like, hey, you should probably do this, guys, because we're going to make it pretty good for you to do this. So they're going to be incentivizing these banks to lend more or less, they get you to save more or less, as a means of changing your spending. Here's the big deal. Monetary policy, just like fiscal policy, is going to end up affecting spending levels in our economy, like AD on your aggregate demand supply graph. It's going to affect that. It's still going to hit the same graph, and kind of the same way. It's just a much more circuitous route. The AD changes with fiscal policy, or increased government spending, which is boom, boom, 1-to-1, right? So the increased government spending, which is a thing that affects aggregate demand, so aggregate demand goes up, right? They lower taxes so consumers can spend more, which affects aggregate demand, causes aggregate demand to go up. Pretty easy to understand, I think, with your discretionary fiscal policies. Monetary's route is a lot longer. It's they hit this, which hits this, which hits this, which hits this, which increases aggregate demand. It's an extra couple of steps. And the vocab is trickier, which is why this ends up being harder. You can still get there. You just gotta slow down your logic, get your brain to line in the puzzle pieces in the correct sequence, and you'll get there. This is an amazing unit for flowcharts. If you're a flowchart person, flowcharts are freaking sick in Unit 4. If you're a teacher, have the kids do flowcharts. If you're a student, draw some freaking flowcharts. Flowcharts are killer here. So, monetary policies. There are two types, just like with fiscal. There isn't like discretionary, non-discretionary though, thank God. These are all discretionary. These are all things the Fed has to choose to do. They are either expansionary, which we call easy money policies, but the term expansionary is the most commonly phrased thing here, which is meant to help out in recessions, just like expansionary fiscal policy was. Yes, we love when it's the same. Okay, and it's going to increase the money supply. They're going to effectively put more money into the economy. How they're doing this isn't through just strictly printing it. That would be bad because of inflation. It's encouraging banks to lend greater amounts, which allows us to access more and then spend more, is the sort of short and sweet of it. So expansionary makes money easier to access. It makes it easier for you to take out a loan. It makes it better for you to spend and worse for you to save. Makes sense. Contractionary policies, tight money, trying to make it so that you're doing less. They're trying to slow you down. And like making fun of your friends' terms, they want you to do less. Right? Be less. You're too much. Calm down a bit. Why inflation? We're trying to counteract inflation. So present day, we're doing some contractionary monetary policies. You'll see this. We'll talk about these in class. Trying to get us back to full employment. Shrinking the money supply. Trying to get us to slow down, make money a little harder to access so that you spend less of it so that prices calm down, right? Because if you can't spend as much, businesses can't charge as much and still exist, right? They'll have to charge less to still function and be around. Okay, so those are your monetary policy types. Tools of monetary policy. There's a Y here covered by my giant head. So these are the 4 monetary policies, the 4 buttons the Fed can push. For fiscal policy comparison, fiscal policy's tools were government spending and taxes. Those are your basics, right? There aren't really basics here. They are all kind of complicated. So I have like 2 slides for each of these, but this is just your list. So you've got what's called the required reserve ratio. It's also referred to as the reserve requirement. That term should be familiar. You should have already covered the money multiplier effect back when you did the bank balance sheets. So that you should already understand is that the banks are supposed to hold on to a portion of your deposits. They can't lend out all of your deposits, and the Fed can change that rate up or down. We'll get into what's happening in the real world now and how this is a lot less relevant, but general rule of thumb for most operating economies in the world for the longest stretch of time was that the Fed or the central bank would set what percentage of deposits banks could mess with and couldn't mess with. Okay. Second one is open market operations, OMOs for short. You'll see these, they'll be listed as either open market operations or most commonly referred to as the buying and selling of government bonds. So we said buying a bond back with the money notes, where you might buy a bond from the government. To be clear, who you're buying that from is the Fed. The Fed is the one who issues those bonds. They're the ones that sell bonds to the public. So when you're lending money to the government, you're actually lending it typically to the Fed. And then you have what's called the discount rate, which is the rate that banks pay when they borrow from the Federal Reserve. So if Wells Fargo or Chase need a quick influx of cash, they could borrow from the central bank, their dad basically, and they'll pay them back interest. That interest rate is called the discount rate. And the last one, which is the new stuff, are these other administered interest rates. These other interest rates that the Fed sets and controls that are meant to sort of push banks a particular way. The discount rate has been around forever. That's one of the oldest administered interest rates. The most sort of important one presently is called the IOR rate, the interest on reserves rate, which is the interest that banks get when they store their money at the Fed. So like, discount rate is if I take a loan from the Fed, I have to pay that back that percentage as a bank. The IOR is if I put money in the Fed to store for later, they give me interest based on the IOR rate. So these are different rates, right? One is a price, one is a return for your commercial banks. So these are your 4, and again, I'm gonna go through each of them in detail so you understand like what's expansionary, what's contractionary with each of these. So the reserve ratio, I'll move this over here for this. The required reserve ratio, aka the reserve requirement, there we go, there it is the percentage of a deposit that a bank has to hold and they can't mess with. They can't touch, they can't change, they can't use that money, right? Only a very small percentage of your deposits historically are actually kept in the safe, right? Because banks lend out money. Well, the money they lend out is money that's deposited there. They use your money for loans and stuff. So only a certain chunk of it do they actually keep at all times. For the longest stretch of our history, that percentage was 10%. That was like your sort of go-to normal reserve requirement was 10%, right? It's called fractional reserve banking because banks can only hold on to a fraction of their reserves. Out of all the money they've got, they can only hold on to a little bit, right? It's called their required reserves. It's the reserve requirement of the required reserve ratio. It's like the proportion of your deposit the banks has to hold on to. So normally 10%. Here's the basic idea. If you raise that, if I make that percentage higher, if it goes from 10% to 20%, banks have to hold on to more of your money, which is cool for you from like a security standpoint, but bad from you from a borrowing standpoint. Because if banks have less money, and this is the thing that you need to listen to, like stop writing. There's stuff to write now. Pause. Stop writing. Listen for this. If banks have less money to lend, loans are going to get more expensive. It's a supply and demand thing, right? Like if banks can't loan out as much money, then they're going to have to charge more for loans to maintain profit. So interest rates will rise and stuff. So when you increase the reserve ratio, which makes it so that banks can't lend as much of your money, they have to hold on to a larger chunk. They cannot loan out as much money. That's contractionary. Because if they can't loan it out, we can't borrow it. And if we can't borrow it, we can't spend it, which is going to decrease spending. So it's contractionary policy. Contractionary is always decreasing spending. It's slowing us down. It's pausing. It's causing us to have a harder time to borrow and spend. When you lower the reserve requirement, say from 10% down to 0%, where banks could lend out all of your money, that's a lot more money that could be loaned out, which means loans will be more accessible and probably also cheaper, ideally, right? So if they do that, then that'd be expansionary, because more money to loan out means more loans can be given out, means more money can be borrowed, and more money can be spent, right? The money multiplier effect is going to kick in big time from your bank balance sheet stuff. The lower reserve requirement is going to make the money multiplier way bigger, right? So increasing reserve ratio, contractionary, decreasing reserve ratio, expansionary, okay? Again, you can write down those things in yellow. The thing I said is the explanation you need to understand for you to not need to memorize the increase, contractionary, decrease, expansionary, because you'll understand why it is, right? The why is the important thing for you to really get, okay? So why would they have to do this? Why would they need to hold on to any amount of it? What's the downside if they don't? Well, it's called their contractual clearing balance. Basically, when you are a part of the Federal Reserve banking system, which if you're a certified bank in America, you have to follow the Fed's rules. And that rule being the reserve requirement. If they didn't follow those rules, they would get in trouble. They could get fined, they could have operations suspended, they can have a bunch of just sort of things that make their lives a little bit harder as a bank, which hurts your profit, which as a business you do not want. Remember that banks are privately owned and operated businesses, so financial hits for them suck. So banks have to maintain that reserve requirement. Sometimes they lend more than they should. They kind of over-lend because it doesn't always work out perfectly. Say you're 10% reserve requirement and you end up lending out 91%, oopsie-daisy, then you've got to borrow that money from somewhere else. You've got to get money from somebody else to cover your bases. You could hope for somebody to deposit more money in the bank, or more likely you can borrow from the Fed, which is that discount rate thing I mentioned, or you can borrow from another bank. They can borrow from each other too, which they pay a different thing there, which we'll talk about later. Not really monetary policy, but an important tool to be aware of. So, next one. This is just why they would have to maintain the reserve requirement, right? Okay, next one. OMOs. This was historically the most frequently used of the monetary policies. This was your most common monetary policy for a very long time. It actually is no longer the case. It's like a 2-year-old change now, but it had been the case for a very long time. The Fed was doing this all the time. These are the buying and selling of what are called government securities. What security in this context means the same as a bond. Okay, so it's that IOU thing. The Fed is buying and selling these government securities, buying them off of the public, maybe buying them from the Treasury Department themselves, and or selling them to the public. These OMOs help determine what's called the federal funds rate. This is a lot of vocabulary. It's highlighted. You gotta write it. Trust me, I know it's a lot. the federal funds rate, which is the interest rate banks pay when they borrow from each other. Like if Wells Fargo has to borrow from Chase, they'll pay what's called the federal funds rate, which is also referred to as the policy rate. Basically just the banks charging each other rate is the federal funds rate. So here's the idea. If the Fed is buying bonds, to be clear, we have to know who's buying from where. So again, this is one of those times where pause the video, write all this stuff, unpause, full listen. Trust me, don't write and listen to this at the same time. I'm going to be explaining this in much more detail than these bullet points do. Okay. So when the Fed buys bonds, they are buying them off of the public, largely, right? That's me. Hi, I'm the public. I'm a person. They're buying them off of us. So when we say that they're buying bonds, they're effectively buying off those bonds from my example before on the video where I was like, hey, you buy a bond, you can sell it to somebody else. The Fed might buy it from you too, which is cool. So say you've got these bonds, the Fed's like, hey, I know you bought that $1,000 bond a couple years ago, expecting to get $1,500 back in 10 years. We're going to give you $1,200 for it right now. You're like, well, $200 in 2 years is better than $500 over the course of 10. That's still, I'll take that. What that means is if the Fed is buying those bonds, where's the actual money going? Going to the public, because the Fed's giving the public money for these bonds, right? People have bonds, they're selling them to the Fed. The Fed's like, here's some money, and now I can go use that money and pay for other stuff. So that's expansionary policy, because they're effectively replacing a thing that wasn't liquid with actual money now. A bond I can't spend. I can make money off of it eventually, but I can't spend it right now. So when the Fed is buying those bonds, they're giving me a bunch of cash right now, which is great. So one, when you're hearing these central bank buying and selling bonds, be aware they're buying and selling them from and to the public. In which case, a lot of times you can just substitute the word bonds for anything else. If the Fed was buying anything off of me, anything at all, then I'd have more money, right? Which means I could spend more, so that's expansionary policy. I have more money to spend. When the Fed sells bonds, that means they're selling them to me, meaning I'm giving the Fed money. Do I have more or less money to spend now? I have less. So it's contractionary, right? Fed sells bonds, I give the Fed money for that bond. Cool, I'll get money later. I will get money later, but later is the key word. Later, eventually I'll get some money. But right now, I got this cool bond that I can't really do anything with. So it's contractionary because they've effectively put a pause on my spending by taking my money and giving me a bond instead as like a savings tool, right? A shorthand for this that people like to use is the Fed buy bonds, big money, sell bonds, small money. Big money, expansionary, small money, contractionary. So buy bonds, big money, expansionary, sell bonds, small money, contractionary. That's a nice little shorthand for it. It says it's the primary tool here. It was the primary tool. Still has been used a lot by the Fed. It isn't the most significant tool, though. It was the most commonly messed with thing for the longest period of time. But over the last couple of years, we have found that is actually not true anymore. We have had to change some stuff. Okay, discount rate, third tool. So the discount rate, again, is the interest rates banks pay when they borrow from the Fed for an overnight loan. Like to make sure that they're maintaining that reserve requirement, to make sure that they have enough money on them to loan out to us, they might have to borrow from the Federal Reserve. Happens. Okay, it's called the discount rate because it's usually a cheaper deal to borrow from the Fed than to borrow from other banks. Otherwise, why wouldn't you borrow from another bank, right? So the thing you got to understand here is decreasing this discount rate makes it cheaper for banks to borrow from the Fed, right? Because now that loan is cheaper, so banks could borrow more money or borrow money more easily from the Federal Reserve. That'd be expansionary, right? Lowering that discount rate would be expansionary because that means banks can borrow more from the Fed. To be clear, they're not lowering the discount. They're lowering the discount rate. The discount rate is just the name of this loan or this interest rate. So decreasing the discount rate is lowering the price of the loan, makes the loan cheaper, which means banks can borrow more from the Fed, which means it's expansionary. Because if banks have more money, then they can lend more money to me. Like I can't take a loan out from the Federal Reserve, but I can take it from normal banks. So if a bank gets more money from the Fed, they can lend more money to me. So lower discount rate, expansionary. Higher discount rate means that it's more expensive for banks to borrow from the Fed. That makes it harder to borrow from the Fed, which would be contractionary. Right? Costs more to borrow from the Fed. Cool, then it's harder to borrow from the Fed. So banks will have less money, it's less easy, less flexible, and that will make it harder for them to spend. Again, the discount rate is typically lower than that federal funds rate, so that's why it's called the discount rate. It's because it's a cheaper loan than borrowing from each other. That's why it's called that. So it's not a discount, it's just cheaper than the other option. So you can either borrow from the Fed at a discount or borrow from your fellow banks with the federal funds rate. And again, banks do this all the time. They borrow from each other, they borrow from the Fed constantly. It's very normal. It's very common practice to see this happen. So again, lower discount rate, expansionary, all that stuff. So why, again, do they need this is, again, if they have lent out all of their excess reserves, they've lent out all the money they could possibly lend out and don't have enough to maintain that reserve requirement, or just to make sure that they have enough money in case anybody wants to withdraw it. It's the classic problem is hey, if the reserve requirement is 0%, which it is right now, and banks could lend out every dollar possible, that's not great, because if they do, then I can't withdraw my money. So they don't lend out everything, but if they lend out too much and it gets a little bit dicey for them, they might have to borrow from either the Fed using the discount window, which is that discount rate, or they'll borrow from each other and pay back that federal funds rate. That's the idea here, right? That's your basic, and I say basic, this is really complicated, I know, but that's the basic idea, is that they might have to borrow from their dad or from their friend. If we want to use a high school metaphor, you can borrow from your parents, which there's a different set of problems when you borrow from them, right? They might make it cheaper for you, might not be as financially difficult to borrow from your parents, right? However, then your parents know that you needed to borrow money, right? They know you needed it, which is a different thing entirely. So even though this discount rate is cheaper than the federal funds rate, it is actually more common for banks to borrow from each other than to borrow from the Fed, because they don't want the entity that oversees them and governs them and makes sure they're not doing dumb things to know that they needed a loan, if that makes sense. Right? It's a little bit of a red flag. Okay, last of the four. This is the newest one. So if you're finding less information about this on your own when you're Googling stuff, that is normal. This is much more recent. This has only been around for a little over a decade now, and we've only really realized the impact of it in the last few years. So, administered interest rates. These are all these different interest rates that the Federal Reserve controls that are meant to sort of incentivize banks either towards or away from lending. So the discount rate is one of those. That's an example. That's the first one that we've been aware of for a very long time in popular understanding of the Fed. It's the discount rate's pretty obvious. That's you make banks borrow from you, you charge them this amount. Okay. The one that's been more recently touted in terms of its importance, and we now have to sort of cover in the class, is called the IOR, also referred to as the IORB, which I just call the IORB rate. And that is the interest on reserves rate, or interest on reserve balance is the B, which same thing. It's the longer name of the same thing functionally. This is the rate the Fed provides to banks when they store money with the Fed. So basically, the banks have the ability to do a savings account at the Federal Reserves, and the IOR rate is the interest rate they receive on those savings, effectively creating a place for banks to put their money where they will actually gain money passively, right? Because if the bank just has it in their own stores, they don't gain money passively, they gain money actively by lending. But this creates a way for banks to make money passively, where they don't have to lend. They can put their money in the Fed, give the Fed more access to more money, which is neat for the Fed to have, but not always the most useful. But does create a new incentive, right? Because if you need to do contractionary policy and you need less lending to happen, creating a pathway for banks to make money passively while also not lending money is pretty good. So this is the newest and most important tool used present day. This is the one that is most impactful in present day United States economy. So raising that IOR rate, basically making it so that if banks save their money at the Fed, they get paid more, is contractionary. Because if the banks are saving their money at the Fed, it's not being used for us. It's not being lent out to us. I can't borrow it. I can't spend it. It's being saved. And again, savings are a leakage. They are a thing that inhibits GDP. They slows down the economy when you save money. Doesn't mean savings is bad. Again, banks are making good profit off of this. Eventually, they could lend out more money. That is good. But short term, raising that IOR rate is going to decrease spending, decrease the money supply, take money, because again, M1 doesn't include money held in the Fed, right? It includes currency in circulation, but if it's held in the Fed, that is just an M0 monetary base situation. Because the people don't have access to it, is the reason, in case you're wondering. People don't have access to that. So it's prevented from being lent if it's being saved there. If you lower the IOR rate, you make it expansionary, right? You're making more spending happening because it's less beneficial to save at the Fed. So why would I bother saving it at the Fed? So if I'm a bank, it might be more profitable to lend it. Basically, the Fed is like offering you a deal as a bank. Either save with us and make money, or lend to people and make money. If they raise that IOR rate, they're going to make saving better for the bank, which means the banks won't lend as much. So it's contractionary. If they lower the IOR rate, they might make lending better, which would be expansionary. That's the idea. And this one, to be clear, this one is so important because this is the thing that is going to be the important tool on the new graph you learn, which is over the reserve market. This is the one that is most key to that graph. So understanding the incentive game here, I can either save it or I can lend it as a bank. What would I do? Whichever one makes me the most money, obviously. So if they make the saving rate better, the IOR rate is your savings rate, and make that better, I'm going to save my money as a bank, which means I ain't lending it. So it's contractionary. Okay. Here's what all of this is. This is me trying to be as straightforward as possible with you. Okay. What do these things do, Mr. McRitchie? Why do they matter? Here's how it affects things. These monetary policies affect what's called the money supply, M1, the amount of money in the economy that we, as consumers, actually have access to. Currency in circulation, money deposited in our checking or savings accounts. This is money that we have access to, okay? So it affects the money supply and then affects interest rates, how easy it is for me to get a loan, how beneficial savings are for me. These are incredibly important, gang. Interest rates are such a key factor in your life that you've got to really hammer home the importance of an understanding. Where if you're buying a house, I don't think any of you are going to be paying in a briefcase full of cash. I imagine you're going to be taking out a mortgage to pay for a house. Mortgage, in case you're wondering, is the loan that you take out to pay for a home. There's going to be an interest rate on that. So if these things affect interest rates, it means they affect how expensive a home is. Currently in America right now, we're in a bit of a housing problem because rent has already been going up. Plus, we're having to do a lot of contractionary policies because of the inflation, and contractionary policies tend to get you higher interest rates. So if interest rates are higher, so borrowing is harder, buying a house, buying a car, going to college get more expensive. Higher interest rates make those things more, anything you need a loan for becomes more expensive. They also make savings better. Your savings account gets better. A bond gets better. Checkable deposits, money market deposits, any sort of savings tool, because they all have interest rates associated with them, also get better because the government is trying to get you to spend less, borrow less, save more. Higher interest rates. If we're in a recession like we were back in the pandemic start, we were trying to drop interest rates as hard as possible. We didn't want you to save. We wanted you to spend. We wanted you to borrow. We wanted you to make big purchases because people were spending a lot less money, which was starting to crater businesses. So this is the whole balancing the economy bit that we've got to sort of play. When you increase the money supply, that gets you lower interest rates because banks have more to lend. Think supply and demand. A larger supply of loans means the price of them should start to fall because we want them the same. So that larger supply should mean cheaper loans. And that would get me more borrowing, which would get me more spending, which would increase aggregate demand, which we know how that affects the economy, right? We've seen that in Unit 3, that you get that higher GDP. Sick. You get higher prices. That's the trade-off. And if you decrease the money supply, if we lower that, we get higher interest rates. Again, saving better, borrowing worse, which decreases your spending level because you'd rather save it than spend it. You wouldn't really want to take out a loan, so you're not going to be spending as much money. But again, when you decrease AD, yeah, you get lower GDP, but you get lower price level too, which that's the whole ticket here. So they do affect it. It still affects aggregate demand, like fiscal policy was affecting aggregate demand. It does do that, which is great. Still moves the same line on my ADAS graph, still aggregate demand. It's just like, how? A little more complicated. Like, this is the short version of how. It affects the money supply, which affects interest rates, which affects AD. Money supply, interest rate, AD. So when I'm doing these, I'm like, when I'm solving monetary policy problems, I'm like, okay, lowering the reserve requirement, right? Okay, banks can lower, if the reserve requirement's lower, banks can lend out more money. So money supply is going up. If banks can lend out more money, loans should get cheaper, lower interest rates. And if loans get cheaper, or there's more of them available, I should be able to spend more. So AD goes up. There's the logic. The logic train is longer. Again, a flow chart is good for this because you could be like, okay, lower reserve requirement gets you higher money supply, gets you lower interest rates, gets you higher AD. Because they do follow this sequence. This isn't all at once. This is bing to bing to boom to bong. It's a ding, doom, doom, doom. It's a chain of events, right? It's cause and effect. It's not one and then finish. It's this to this to this to this to this to this. You gotta understand that sequence. It's a lot, I know. That's why this class is hard. Okay, so here's some examples. Okay, giving you a scenario. Pause the video, go through these. Give you the scenario, figure out, is this a monetary or a fiscal policy? Is it expansionary or contractionary? And what will happen to inflation and GDP as a result? Those last two are based off of your aggregate demand, aggregate supply graph. So pause this video, goes through these 5 areas of monetary or fiscal, is it expansionary, contractionary, and what should happen to GDP and inflation as a result. And unpause. So, an increase in taxes on wealthy individuals specifically, but it just increase in taxes, period. Taxes is fiscal policy, right? Taxes are done by Congress. The Fed does not control taxes or government spending, so it's a fiscal policy. Expansionary or contractionary, that should be contractionary, because if you raise taxes, people can't spend as much. And if it's a contractionary policy, aggregate demand should go down. So AD shifts left. Visualize it. AD goes left. My GDP is dropping. My price level is also dropping. And that's the point of a contractionary policy, is to stop inflation. So inflation goes down, so does GDP. Decrease in the required reserve ratio. Okay? Again, this is a monetary policy. If it's really complicated, if it's all these weird vocab terms from today, it's monetary. So monetary policy. Expansionary, contractionary. Okay. Go through the logic train. Lower the reserve requirement. What does that mean? Okay, well, reserve requirement is what banks have to hold on to. Banks have to hold on to less so they can lend out more, so we can borrow more and spend more. Got it. Expansionary. More that we can borrow, more that we can spend. Expansionary policy increases AD, so higher inflation, higher GDP. Got it. Increased discount rate, monetary policy. Expansionary, contractionary, here we go. I've got to know the definition before I can even start, right? I got to know what the hell the discount rate even is before I can start trying to explain what's happening. So what's the discount rate? It's the price of a loan from the Fed to a commercial bank. Okay. Have your journal out. Go through it in your journal, right? Okay, it's the price of a loan from the Fed to a commercial bank. Okay, so that is now higher. That price is higher. That loan is more expensive. So if that loan's more expensive, banks will borrow less from the Fed. If they borrow less from the Fed, they have less money on hand, or it's harder for them to lend. So it's harder for us to borrow, so it's contractionary, right? Like, this is the sequence of logic you have to do. Usually what my sequence of logic comes down to for expansionary or contractionary is, do banks have more or less money? Do like regular banks have access to more or less money? More? Sick. Expansionary. Less? Contractionary. So increases discount, banks have less access to money. Contractionary decreases inflation, decreases GDP. Increased military budget, that's fiscal policy, that's government spending, that's straightforward, easier. Increased government spending should be expansionary, more spending happening, GDP should go up, inflation should go up. And the Fed buys securities, again, those are bonds on the open markets. They're buying bonds. Again, we've got to know what that means. Okay, who are they buying them from? The public, always. Okay, so the Fed's buying bonds from the public. So the Fed is buying a thing off of us. How do they do that? They give us money. There it is. The Fed gave us money. They bought the bond off of us. That means they had to give us money. If we have money, expansionary. We've got more money now. Banks have more money now. I have more money now. Sick. Expansionary, increase. That's how we do it. So, here's the last couple of things. I'd say about 10 minutes left in this lecture. Full 45-minute one, I know. It's a lot. I'm not going to apologize because I want you to understand this. So, a new thing. This is brand new added to the AP exam. Ditto for the IOR rate. This is the other new thing to know from these notes. 2 different types of economies from a money supply standpoint. Okay? You have an economy that has limited or an economy that has ample reserves. What they're referring to is the amount of money that the banks have access to effectively. Limited reserves means the money in the banking system is pretty limited. There's a pretty solid ceiling on it that they can't really go past. Okay? The central bank manages the supply of reserves to meet banks' needs. They do expansionary to give them more access. They do contractionary to take away from the money supply. It is quantity-based. Okay? The idea is literally change the amount of money that banks have access to. Right? So it sounds like what we've been talking about, right? It is what we have covered so far. The things you have seen. Sorry for my laundry. Those are the things we have seen, right? The Fed buying bonds means banks get more money, so that's quantity based. This is America pre-2008. This is a lot of the world's economy pre-2008, and it still applies to a lot of countries. Still, probably your medium, large, and smaller. Like large and higher probably don't have this rule really applying to them anymore, but your like medium, in between medium and large and below still probably have limited reserve framework. This is how we believe the financial system always would work. We were under the impression that this is like the only truth. We were wrong. Classic. It's the problem with just sort of anything is that you like have rules and ideas that you think work all the time, then you find out new stuff later. Sucks. It's like growing up. Ample reserves is the other framework. What it means is that the amount of money in the banking system is so significant. There's like too much in it, not infinite, but so much in it that the quantity-based stuff doesn't really affect things. When they say the policy rate, they mean like interest rates that we interact with, the like targeted one. Like if the Fed wants to lower interest rates, they're like targeting a lower policy rate. That's what that phrase means. Effectively, the central bank has given too much money to the banking system over the course of a period of time. This is what happened. Basically, 2008, in the financial crisis, the Fed pushed the expansionary button a bit too much. Is probably the simplest way to think about it. They hit expansionary a little bit too hard. Banks now have a bit too much money, and the Fed can't just take it from them, because that would be technically like stealing, right? The Fed gave it to them. It's much harder to take it away. So what that means is your quantity-based stuff doesn't really work. We have reached effectively a breaking point in terms of banks have too much money, so just affecting like the amount of money that they have doesn't really work because they have trillions as opposed to billions. What does that mean? It means the only monetary policies that actually really do anything to interest rates are the ones that directly affect interest rates. The administered interest rate stuff, your discounts and your IOR rate. Those two actually matter. The reserve requirement and the OMOs have found to be not really effective in terms of affecting things, which is why the Federal Reserve no longer has a reserve requirement. A reserve requirement is 0%, and the Fed has mentioned that they're probably never going to change that back. It doesn't seem to be impacting anything when we change it. So we're going to leave it at 0 and give banks full flexibility, which is a bit concerning for people who don't trust banks, but the goal is just like, hey, that's a piece that we can't even really use anymore. For the AP exam, you still have to know the limited reserve stuff, because you'll have questions that say, hey, in an economy with limited reserves, what would work? And the things we've covered, all 4 of those would work. Your discount rate, your IOR rate, your OMOs, your reserve requirement, all those are fair game. All those work. It's if a question says ample reserves, which it will be less, it'll be a smaller percentage of the questions. We'll say ample reserves, then it has to be one of the interest rate ones, which is either the IOR rate or the discount rate, which is nice because they're both called rates. So like, have to use a rate problem, a rate solution when it's ample reserves. This is America since 2008 functionally. So we found out then, whoops-a-daisy, we kind of made 2 of our 4 buttons irrelevant. 2 of our 3, they had to add the IOR rate as a means of doing it. So ample reserves is the framework we're currently utilizing, but be aware for the AP exam, either will make sense. So here's what I would write down is the monetary policy tools in different systems. When you hear limited reserves, here's what you can use to fix stuff. OMOs works, discount rate works, reserve requirement works, administered interest rates like the IORB work. They work. They all work. Like how I was describing before, all of those work. Because what I was describing before was a limited reserves framework. The big idea is that we change the amount of money that banks have, and banks will change interest rates based off of that. Right? We'll change the amount of money that they have. Not by, not like cut it in half or anything, but by enough, because they don't have that much. That'll mess with it. To explain why that, why the quantity stuff doesn't work anymore, think if I take, $1 million away from any of you, you would have negative money. If I take $1 million away from a billionaire, it doesn't hit them very hard. Right? It doesn't affect things that much for them. They have plenty of money, right? So effectively, we have created a system where all of the big banks have way too much money that any of the sort of basic buttons that we had, which just sort of trimmed it, don't do anything. They don't swing the needle enough. Like they might change it by like thousandths of a percentage, but that is not significant. For the ample reserves, the only real monetary policy that works is administered interest rates. And you could specify the I or the discount rate. Either is fine, and it's still raise is contractionary, lower is expansionary. That still it's still the same button. I'm pushing up or down. The OMOs don't really work in terms of interest rates. It's just to sort of maintain the number in the reserves. But OMOs are not effective at changing interest rates anymore. They're effective at changing the amount of money that banks have on them in a given moment, but only by a little bit, not by a significant amount. The reserve requirement's fully gone. We don't use it anymore in America. You should still know it because other countries will still use it, and who knows what the world exists and changes. We might bring it back eventually, but at least for now, the reserve requirement no longer matters for America. For your AP exam, it does. Careful. This isn't a U.S. economy class. This is a macroeconomics class that we teach in America. So we use America for most of our examples, but it doesn't mean you should only know things that America deals with. You should know things on a global scale. So, last thing. This is my big flow chart for monetary policy. Looks like it's a lot. It's less than you think, because a bunch of this stuff is like duplicate. So when you get questions about monetary policy, especially FRQs, but even multiple choice questions, here's the sequence that should be going through your head. You see a question, figure out what type of economy are we looking at. The question will tell you. The question will say, and I've seen it on all these questions that they've been releasing, it says, given an economy with ample reserves, given an economy with limited reserves. It's like the very first thing they say. Okay. I see limited reserves, I see ample reserves. I have to figure out what are we trying to fix, right? If we're using monetary policy, we're using it to fix a problem. What is that problem? If we're trying to fix a recession, aka a negative output gap, or just the problem is that there's a lot of unemployment, because these are all things that would be happening at the same time, right? Any of these following situations would work, which is the lower reserve requirement, it's expansionary, right? You need to do expansionary policy, so lower the reserve requirement would work. Lower interest rates, your discount rate or your IOR rate, either is fine. Or purchase bonds. Have the central bank, have the Fed buy bonds. Any of those three, buy bonds, big money, right? Lower reserve requirement, banks can lend out more. Lower administered interest rates, banks can lend out more. Those are all good. Okay, you need to do expansionary policy if I'm in a recession, right? So any of those expansionary policies will work. If I'm doing limited reserves and I'm in an inflationary gap or a positive output gap, doing the contractionary policies will work. A higher reserve requirement will work. Higher interest rates, like your discount rate or IOR rate, would work. Central bank selling bonds will work. Any of those works. Again, if I'm in an inflationary gap, I need contractionary policy. If I'm in a recessionary gap, I need expansionary policy because I need to fix the problem, right? If we have an ample reserves framework, the nice part is there's fewer answers, which just means you don't have to think of as many things. If I see ample reserves, all I can do is the administered interest rates, A. Ample reserves, administered interest rates. That's all I got, okay? If it's an inflationary gap, the contractionary thing is raising those interest rates. Again, raising interest rates reduces spending. If I have a recession, I lower those. And that will get me my problem solved. Here's the thing. If I'm a lazy person, which I am, only one monetary policy tool works for everything. Works for ample or limited reserves. It's the interest rates one, right? Like, in a recessionary gap, on either recessionary gap, right, left or right, I have the same answer here. Lower administered interest rates, lower administered interest rates. That one works for either. In an inflationary gap, raising the administered interest rates works for either. So if I'm doing a monetary policy problem on an FRQ, I'm going to use administered interest rates regardless. I'm going to use administered interest rates because I know that hits the same for either, right? Doesn't matter if it's limited or ample reserves. Administered interest rates works as a monetary policy for either of those two economic situations. So I'm going to use that either way. I'm not going to mess around and try to pick another one. Nope. Just going to use the administered interest rates one because that one always works. Why wouldn't I use the one that works for both, right? If it's limited reserves, then I could also use the reserve requirement and the buying and selling bonds thing. I can. But if it's ample, I can't use those. Be aware that on multiple choice questions, you do have to know all of them because they might ask you for things that are specific. And on an FRQ, they might say it's limited reserves, and they might ask which open market operation you have to use, which would mean I have to say whether they buy or sell bonds. Crap. Like, you need to know all of them. But the one you've got to know the best is the universal, which is the administered interest rate one, is your always works regardless of which type of economy am I looking at, ample or limited reserves. Okay. That is everything for the monetary policy stuff. Wasn't that easy to understand? Wasn't all of that not giving me a headache right now? No. That was all very obvious stuff. Yeah, guys, I know that stuff's hard, for sure. Oh my god, it's a lot. Familiarize yourself with the vocab first. Start with the vocab. Start vocab first. Know what the reserve requirement is. Know what the discount rate is. Know what OMOs mean, which is buying and selling bonds. Know what the IOR rate is. Focus on that first. Get the vocab down first. Then go from there to the, okay, doing what to that thing is expansionary and contractionary. Not just memorizing it. Memorizing it, you'll mess up. You'll forget. It's fine. Understand it, which is, okay, is it easier or harder for banks to lend now? If it's easier for banks to lend, it's easier for me to borrow and spend. That'd be expansionary. Easy money, expansionary, right? Is it harder for them to lend? If it's harder, then I won't be able to borrow and spend as much. So it's contractionary. So you got to really get the vocab to the point that you understand it, that you can go through these problems and be like, okay, doing this to this is this because this. You got to understand it. It might take you a while to figure out. Might take you watching the video again. I know, it's a lot. It's a long video. I understand. It might take just a crazy amount of practice problems, but you've got to be really deliberate here. This is a thing you have to be really deliberate about to understand. It takes a while to get these down. And your tests over this stuff might be in 2 weeks or less, probably, for most of the people that are taking this class. So be really on top of it, gang. The monetary policies are super important to know because these are things that affect the next 3 graphs you'll learn. All the graphs for this unit get messed with by monetary policy. So you have to know which are expansionary, which are contractionary, for you to get the shifts on the graphs right. You guys know how important that is based off the Unit 3 test. I think you all have a good idea of how important that can be. So be very, very careful and cognizant of that stuff. Cool? Cool. As always, if you have questions, please leave them in the comments. I'm sure there are plenty over this stuff, especially the ample versus limited reserves thing. That is weird as hell. Feel free to leave questions in there. I'll do my best to answer them. We don't have a lot of information at this point from College Board in terms of how much of this is going to show up on the test, how they're going to ask about it specifically. We've seen some questions on AP Classroom. You'll see some in your classes and on your tests and on your practice tests and stuff. But it's a lot. It's just a lot, gang. So thank you all for watching as always. Again, feel free to like or subscribe if you want. Don't feel pressured to. And if you've got questions, ask them. But thank you all for watching, and I wish you all the best of luck. Appreciate it, gang.